Many hard money lending companies eventually run into a liquidity problem when they have more deals coming in than capital to fund their deals. You might find yourself scrambling before every closing, waiting for an existing loan to pay off, or just piecing together some funds you have here and there last minute while pushing a deal that needs to close immediately back a little bit to ensure you do have the funds ready to close. I'm going to share my screen here in a second and break down the basic 101 and then the advanced strategies that we've been using over the last 18 years to raise capital. Remember to always check with your attorney, CPA, and other professionals, as this information will just be educational use only. Many hard money lenders typically raise funds through high net worth accredited investors, either through the direct placement model, where they can co lend, or the fund model, while some even raise capital through promissory notes directly to their business. However, you structure this, though, inside your business, these strategies will help you grow your investor base. Let me share my screen real quick. So let's get a better view right here. Okay. So this is a whiteboard that we have in our office, all broken down. And I'm going to go through this for you so you can see. So we're going to start with the different personality types that you want to raise capital from and which ones you don't want to raise capital from. Then we're going to go through kind of who the target capital investors are. And then we're going to go through 101 or 1.0 and then 2.0. And both of these is honestly like a game changer. It took us probably, when we started maybe 18, 19 years ago, it took us maybe 2 or 3 years to figure this out just from trial and error. And after we figured it out, honestly, it was a no brainer. So let's talk about DISC personality type. If you're familiar with DISC personality type, and there's a lot of different types of personality typing tests out there, but it's kind of a game changer because it really helps you determine who different personalities are. We don't just use this personality for raising capital, but we also use it for working with borrowers, some employees, and things like that because these personality types tell you a lot about folks. So, for instance, a D personality or a dominant. Let me move my screen over a little bit. We'll get back to some of this other stuff here in a second. So, the D personality types are typically, business owners, successful entrepreneurs, real estate investors, doctors, lawyers, things like that. They're kind of like alphas. They control the situation. They're intelligent. They understand things very, very quickly. And if they tell you they're going to do something, they're going to do something, right? They're just very adamant and they're just quick to decide. And honestly, they're easy to deal with. Now, I understand that you might get discouraged when working with some of them because they feel like you have the sense that, oh, hey, they're my boss, they know more than me, or they have a strong personality type. But that's a good thing because keep in mind, if you are raising capital for your real estate deals, for your loans that you're going to be pulling their capital in, you want someone who's going to be direct and easy to work with. And the important part to remember is you're controlling the deal and you get to determine who you're raising capital from and who you're not raising capital from. So, if that's the case and you have strong investments and you have strong deals that you're going to be raising capital for, you want someone who, when they tell you something, they're going to be very decisive and easy to work with. So D's are some of the best ones that we work with. Then we have S's. So these are the two that we stick to, and then we're going to talk about the ones we don't stick to because both of these can be dreadful if you go down this road. So steadiness is a lot of referrals, a lot of passive investors, maybe some relatives, other folks that maybe own business, maybe they don't own business, but they're very trustworthy. So if you get a referral to them and they decide to work with you, they're going to be easy to deal with because they're going to trust that you're the expert in this space and they're going to deploy capital to your fund or through your co-lending arrangement. And as long as you continue to take care of them, they're going to continue to want to work with you over and over and over and over. Now, they also, they have good attention to detail, but at the same time, like they just don't want to do the heavy lifting. They're already busy professionals. They just want you to handle everything. They're very, very good to work with. And again, they're non-confrontational. As long as you're doing a good job right by them, they're gonna and they trust you. Everything will work out fine. Here's the problem with I personalities and C personalities. So influencer personality type, that's like the life of the party. They think they're the big. Sometimes they come out as a big shot. Oh, I know this person. I know this person. Oh, I can help you with this. I can help you with this, and that's fine. But the problem with a lot of them, we've realized, just don't have a lot of investable capital. They're kind of all talk, but never can pull the trigger in order to do a deal. Probably because they don't have investable capital, or they're so, they're fun people to hang out with, but you got to watch them. And one thing to note, everybody has a little bit of all of these in them. So we're talking about their primary trade, right? So, some people might have, almost everybody has a little bit of this. And if you actually do, and I encourage you to go to just search up like disc personality types. Tony Robbins has one that he does. Type in Tony Robbins' disc personality type, take it, for you. So you know what you are. Um, but it's a really big advantage when you understand some of this. So stay away from eyes, stand away from conscientious. These are more engineers, accountant types, stuff that are just very analytical. And again, the thing with accountants, which is interesting, is we actually have a lot of accountants that have some C, but then they also have some D, so it works out. But what you don't want is the person who is just overly analytical and they just their attention to detail is just too crazy that analysis paralysis. They'll never be able to do a deal because they just will talk themselves out of everyone. And you can give them like, 100,000. You could be doing $100,000 loan on $1 million property to a 800 credit score borrower, and they're still going to say no because they're going to find a reason why to say no because they're just too analytical. So they're hard to deal with, unfortunately, on the front end. And here's the other thing: if you do decide to get money from them, they're going to just nickel and dime you to death, and they're going to ask lots and lots of questions. Oh, hey, how's this project going? How's this project going? How's this project going? Right? The purpose of doing private notes and investing capital is you're the expert, right? And you obviously have to have the good deals, and there has to be a trust that you're going to, take care of everything and you're going to be servicing these loans. So it's hard to have someone who just needs constant status updates over and over and over. Again, that's up and above your, the regular updates that you do for that. So I would stay away from that. I would stay away from that. Focus on these two. Good things will happen. Now, typically, the targets are, if you remember LinkedIn, if you have a LinkedIn profile, if you remember how LinkedIn it used to work, they used to have first degree network, so this is the people you knew, and then the second degree network, which is the people that your people knew. So let's say you know like a few dozen people, and then each one of those people know a few dozen people. That's kind of the second degree network. And what we found, without doing any marketing, all of these people is all you need in order to grow your database of capital investors to invest in your fund or invest in your co-lending agreements, your co-lending setup, depending on how you have that set up. We also found that this is typically the target. Someone who has investable capital, not somebody who needs this for cash flow, investable capital to, that's looking to invest money into an investment between 50,000 and 2 million. That's typically the right one. And I know I keep using the word investable, in investing. A lot of these are, co-lending, together, but I'm just using the word capital investor and investing, just so you understand the point, because they might be investing in a fund if you have a Reg D, SEC fund. And, these days you can almost get a security rider, or you can do a security for almost all of these and register them all if you want to do co-lending, if you want to do promissory notes, if you want to do a fund. Definitely check with your attorney on that. But there's a lot of, as private lending's gotten more and more popular, there's a lot more ways that you can legally raise capital, which is nice. Okay, so we found that investable capital about 50,000 to 2 million is good. The reason why we say no whales is someone who's got like 10, 15 million that want to invest in this asset class. They're looking typically for higher rates of return, and they're usually looking for stuff that's more tax advantageous. So typically the rule of thumb is capital investors get maybe about a 10% return, give or take. That's usually what works. Returns less than that, you're probably going to get someone who's not sophisticated or maybe not even accredited. So that makes it a little bit challenging. And then someone who's a whale that has a lot more money to deploy, they're probably looking for higher rates of return. So it might not work. Not saying it doesn't exist and then they can't deploy part of their, assets with you, but we found it between 50 and 2 million is idea. And we kind of went through kind of all these targets, that represent a big part of our capital base. So let me erase all of this stuff and we will move on to the real secret sauce. Because this really is the secret sauce, is the way that we kind of work step one and step two. Again, there's some more advanced trainings that we that we talk about in the mastermind group. You just go to hardmoneymastermind.com, and we there's some more advanced kind of trainings. I wanted to give you a broad overview of how we raise capital, though, because I think that's an important topic, especially if you are trying to grow your hard money lending company. So this next step is really what got us from, I don't know, a few $1,000,000 deployed that we fumbled through to 50 million that we do yearly in an outstanding portfolio. So let me zoom in on this a little bit so you can get a good view of this. Okay, so this is typically how the flow works. So we start with kind of an introduction, right? It might be a friend of a friend that you know. It might be, maybe a colleague, and it's like, hey, I know Jason's doing some good things, lending money out. Lend some of his own money out, lend some other friends and family and some business colleagues money out, and they're potentially looking to grow a little bit. They might be interested in deploying some of your funds. Great. So you do some sort of introduction. So that's kind of step one, and then you move on to putting together an email and a pitch deck. We actually have a pitch deck in hardmoneymastermind.com as well. So email them a pitch deck with a few things, obviously, like how the loans are structured, the terms of the loans, what happens in default. That's obviously one that people have a lot of questions with. And then the most important part of this is outlining case studies. People like case studies of actual deals and what they look like. So outline a bunch of different case studies. And if you've never done a deal before, if you're newer to this, what a sample deal will look like. So a sample deal would look like this, right? So I lend in this area, I lend in Maryland, and all of our loans are 75% LTV, or the borrower puts up 25%. They all have this particular credit score. They're putting down, 25% down payment. So we give them, 75% of the purchase price, 100% of the construction costs. They meet this criteria, blah, 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 right? Like kind of just a sample of what it looks like. And if you have real deals, go through that. So put all of that as case studies in the pitch deck, because people want to see like what type of deals that they're co-lending with, or what type of deals that you're investing in. I think that goes a long way. So start with that, and that should really spark their interest, right? And be like, oh wow, these are local deals. They're near me. The borrower's putting a lot of money down. They're good interest rate return that I could potentially get. Like these are, good deals. Like I could invest in some of those deals. So in essence, get that pitch deck out so they agree for some sort of next steps to answer. Now, an in-person meeting's ideal. If you can't do an in-person meeting, you could do Zoom, you could do a phone call, whatever works best. Ideally in person, but however you want to set it up. And this is where things get interesting, because obviously you're building rapport. People do business with people that they like. You're building a relationship with them. But typically of what we've found, and this is a buy question, our conversion rate has been so good because of this one thing. Typically, you go through the deals, the case studies, you tell some kind of war stories of, oh, yeah, we had this deal, transparently. Like, these are the deals that we do. This is what it takes to run a hard money lending company. You could go find deals yourself and lend if you'd like, right? And you can make, whatever, 13% and 3 points yourself if you want to go find those deals. But the reason why we've had success in our lending companies is because we go and we do everything. We go find all the good deals. We look at 100 of them before we close one, right? So we find all those deals, plus we do all the servicing and all the other stuff. Anyways, typically at the end of the conversation, what will happen is they'll say, yeah, so I have a question. So the borrower's putting down 30%. They have good credit. They have experience. Why don't they just go to a bank, right? Like that's the question that almost everybody asks. And that's a buy question. Like they're in if that's the case. Why don't they just go to a bank? And he's like, well, you know what? Most of the loans that we do, most of the borrowers that we do are bankable. But the problem is borrowers don't want to go to a bank. What do banks not like? They don't like construction loans. Banks can't close in 3 business days. Banks are going to make you provide every tax return for every entity that you own and make your spouse sign. That's a pain in the neck. We want an easy, a real simple solution from a local lender, this, and keeps it very, very simple. So that's the reason why, they don't want to go to a bank. They want to keep it simple. Now that doesn't mean that some of the fix and flip borrowers out there, or borrowers that we do on commercial properties or rental properties, that doesn't mean they don't use a bank. Sometimes they do, but not every transaction works. If you're trying to buy a property to fix and flip, and you go to a stressed seller that needs to close in like 10 days, and they give you They get you, they're willing to sell you the property at a big discount because you can close quickly. You can't go to a bank. That's not an option. So most of these borrowers are bankable, but because they need speed and convenience, they're willing to pay higher terms to do so. Okay. So that's important right there. So the next step, and this is like the most important step, is at the end of like, okay, what is the next steps? Typically what you'll say is, hey, listen, we don't really have any opportunities currently available that we need capital for, but we are growing and we probably will in the future. We should circle back soon, maybe like 30 days, a month later, type of thing. And that's important because if your response was, sure, I got this deal, I got this deal, I had this deal, like they were supposed to close yesterday, but like I don't have the money, so blah 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 blah. People are like, yeah, I don't know if I want to work with this guy. This guy's desperate. But if you're like, yeah, I don't have any of these really, really good opportunities, but I should soon. And when I do, I'm happy to hit you up and, type of thing. People are like, okay, no problem. Like they're not desperate. So that's important to put them on the shelf. And then a month later, you have a real deal, either ready to go in your fund or a co-lending agreement and says, hey, good news. We were able to get some new deals. We're ready to go. Are you still interested in proceeding? Answer any questions, and you keep it moving. And that's usually a very, very high rate. Because keep in mind, nobody gets past this unless they're ready anyways, right? Because if someone's looking at your sample deals and they're eating them up and be like, yeah, I don't think I would do that deal, or, why would you do that deal? Or I would do this separately, or I don't want this. You're not going to get to the next step. Like all of that stuff has to happen first. But if they look at 3 sample deals and all of them are like, oh yeah, that's a good deal. That's in my local area. I love that deal. Or that's a good deal. That's good. That's a deal. The next deal you send them is going to be the same. And if they get to this point and they turn down that deal, or they're like, yeah, I don't know, I'm not really feeling it. Typically the rut is, then you know what? Unfortunately, this investment probably isn't best for you, because this is what all our deals are going to look like. I showed you some sample deals. These are the deals that have worked. We've had a lot of success with them, and that's fine. If they don't work, they don't work. If they're not comfortable with them, that's not a problem. But if you do a lot of the heavy lifting and due diligence on them ahead of time, by going through the personality types, determining on who they are, showing them the sample deals, and them kind of being interested along the way, by the time you get to Q&A on a real deal, or when they're ready to invest in the fund, chances are there's a high likelihood that they'll be ready to go. So then you'll email agreements, wire information to them, to get everything moving. You get you get loans closed, and you start, dispersing them checks or funds via ACH, and then you define the communication system of when you're going to hear from them, how the reporting comes in. Do you do it on a per property basis? Do you do it on a whole fund basis? So that's like very, very important to start getting deals in the door. And this will get you to whatever, uh, 3 million, 4 million, $10 million worth of deployed funds. This is the way you have to do this on every single borrower. I remember years ago, because we haven't raised capital for a long period of time, because I'm going to go through 2.0 here in a second about how it just snowballs and grows for you. But I remember we got a referral from one of our good capital investors, and he was like, hey, I got a friend who's interested in investing, blah, blah, blah. We meet with him. Sure, no problem. And we met with him, and he was referred. He was like ready to go, right? He was like, hey, I heard you guys been doing really good things for so-and-so for 10 years. I'm ready. I've got a good amount of money I can deploy. What's the next steps? And we followed the same process, right? We followed the exact same process. And he's been a really good capital investor for of ours for a long period of time now, even though he came from a very high rated referral, and he probably would have invested anyways, but we still followed the same process. All right, let me erase this, and we will go to 2.0. All right, let me move some of this up. Okay, so this gets really interesting, because this is where a lot of folks in our mastermind group, they've either fumbled their way through, or they've followed this script, and then they're kind of at the point where it's like, hey, I'm looking for a little bit more capital. So usually what ends up happening is capital will grow organically itself. Now, again, this stuff doesn't happen overnight, and I get that. But a few things. So we've never really done much marketing, but like if you were going to do some marketing to this, just email the database of capital investors that you have, and maybe some referrals and some of their friends and family and other people that are interested in investing in some deals, right? So the only thing that really needs to be emailed to them is just case studies of closed deals, right? So you close a deal, someone else funds it, or somebody's invested in it, maybe it's through the fund. Um, and in essence state, hey, we just closed this deal on 123 Main Street. The borrower put down 30%. They had a 700 credit score. Here's some before pictures. Um, and this is some renderings of what it's going to look like afterwards, blah, 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 blah. We were able to close this in 7 days. That's why the borrower used us and not a bank. I'll continue to stay in front of you, um, and for other closed deals, right? Because you don't want to fish and send them live deals. That discredits this whole thing. I wouldn't do this. I'm just talking about closed deals after it closed. So these potential capital investors can see the types of deals you're doing. So a few things happen with that. First off, it's a good look. You're sharing deals that you've closed. Your current investors know what you're up to. Your potential investors like, oh wow, they did this deal. This is great. I should have got into that deal, right? And then maybe they'll reach out for the next deal. Or your current investor will be like, oh yeah, I've got, I just did a deal and I got $100,000 coming back. I could invest in their fund in the next deal, right? So it's a good way to kind of case studies and testimonials have really go a long way. And then, right, so that would be a list inside your database, right? It would be a separate list than your borrower list, right? And why, we talk about lots of videos about how to generate business to lend to, but so this would be a separate list inside your database. Okay, so the next step would be having proper software. Now, the big softwares in this space is lender software and the mortgage office. So lender software is spelled LENDR software.com. That's one option. They're actually one of the sponsors of our mastermind group. So I know a lot of folks in our group use them. And then there's also the mortgage office, which we know a lot of people that use the mortgage office as well. But having the proper software in place ends up being a capital raising machine for you. Here's the reason why. All reporting comes out of that. All monthly payments come out of that. All communicate, you're communicating with them out of that over and over. One hack, and this worked for raising money for hard money lenders. We had a buddy that was raising money into a fund for a syndication on an apartment building, and he followed the strategy as well, is pay your investors as often as possible. It's kind of be an industry to pay monthly, or if you're like in a syndication, maybe quarterly through a fund. The more you pay them, the more they're going to want to reinvest with you, and the more you can stay in front of them. So when I say pay weekly, I don't mean like take the payment, divide it into 4, and then pay it weekly. I mean pay weekly, like whatever funds came in that belong to them the week before, disperse it that week or disperse it that following week. So for instance, in a lending company, like when do you get paid? Monthly payments, right? So most of our loans, 90% of our loans pay, first of the month or whatever, right? Early on in the month. So that following week, all those payments will come out. But there's also other times that you get paid. Like there's per diem interest, right? So if I close a loan on March 15th, call it, I'm going to have per diem interest till the end of the month. So that following week, when I say per diem interest, like the borrower is going to prepay of 15 days worth of interest, or they might even have prepaid interest, but call it that way. So with that following week, there's funds that are getting dispersed. Let's say I have a loan that pays off April 15th, right? There's going to be 15 days of interest. That's got to get dispersed. That pays out. So all the money that we get in this week will get dispersed to the parties the following week. So not only are they getting funds in their account, but they're also, getting notifications. They also get monthly statements. So there's lots of communications back and forth through the software, where in essence gives them lots of reasonings to be like, hey, by the way, I've got more funds available. Can you deploy it for me? It goes a long way. Then we get to ask for exclusive referrals. Typically, if the time comes and you're looking to raise more money, why not hit your current database up? Because sometimes that'll inadvertently raise money from them. Sometimes they'll tell their friends and say, "Hey, listen, I know I've never really asked you for additional funds, but we are growing, we are expanding. We've got an uptick of applications. I think I could probably deploy another few $1 million here in the next few months. If you know anybody that that's looking to get involved in our fund or do co-lending with us, I'd love to chat with them," type of thing. And that's a great way to, generate by just asking. Again, all of this stuff is working with what you currently have in place. Um, okay. So another thing is at some point, you're going to get to a point where you have investors that are just kind of become a pain in the neck. And when that happens, cut them if you need to. And I know sometimes it's taking a step back because it might be capital that you need to deploy, but it could end up taking 2 steps forward if it gets to a point. We haven't had much turnover inside our business. Most capital investors, as soon as they're in on the fund, they're in a co-lending agreement. It's not like they're in for a year and then they're like, or one deal and they're like, okay, I made my 10%, I'm out. They're usually in, they're getting, their interest payments, and then they put in more money and they tell their friends, they tell their family, and things like that. And it does get to a point sometimes that you have someone that, might not, cherish their relationship. They might be a pain in the neck, you know, cut them, send them their money back, keep them moving. And again, stick to the process. I'm telling you, like, this process works. We've done it on everything after the first few years of the business. Stick to that process, and all of that stuff will end up being, more funds than you can even deploy. Because keep in mind, we have $50 million portfolio. If our average return to capital investors is 10%, do the math. That means at the end of the year, there's going to be $5 million of more money that we can deploy. We can't grow quick enough doing loans to deploy all the capital that we have. So you get to a point as you're growing, that's a snowball. Just keep getting bigger and bigger and bigger and bigger. And just continue to create relationships with your capital investors, face-to-face meetings, doing dinners, lunches. It's a long-term business. This does not happen overnight. I'll give you an interesting stat. So we've set up a few different offices over the years, and the relationship that we have with our partners is we'll put up all the capital, we'll do all the back end. They're responsible for finding deals, and we underwrite them, obviously, to make sure they're good deals together. But capital is not a constraint. It takes us close to 3 years to deploy $10 million in a market, sometimes even longer than 3 years. So this doesn't happen overnight. If you're growing that quickly, you got to be careful. You want to make sure you're doing this responsibly. And a lot of folks, laugh at me in our meetup at our mastermind group because of this, because I talk about the seesaw, and the seesaw is a real thing, right? And what I mean by seesaw, if you're looking at the screen, I'll make myself a little bit bigger, is too many deals, not enough money. Too much money, not enough deals. And you got to continue to follow that and follow that and follow that. And then eventually you get to a point where, it ends up being a little bit equal, right? But it takes time to do that. And that's just part of the business. And another thing to really keep in mind in this business is, like, you got to be raising capital and doing investor meetings just like you're doing borrower meetings. Like, that's important. When people are like, oh, like all these deals and I don't have any money, it's like, well, how many investor pitches did you do this week? Well, I was able to do like 3. I'm like, 3? Well, how many borrowers did you talk to this week? Oh, I talked to like 30. Okay, well, go talk to 30 capital investors. You got to do the heavy lifting to get that snowball running. The good part, the good thing, though, is after the snowball of finding deals or finding capital continues to snowball, it gets bigger and it grows and it grows and grows. Because in essence, a capital investor should continue to stay with you, refer their friends, maybe put in their IRA money, put in additional funds through you over and over and over. So it turns into a really big thing. Now, all of this that we just discussed, all of this is contingent on you having good deals and good opportunities. So I would challenge you to make sure you're out there finding great deals. If you find great deals and you have good loans that you're doing and you're servicing them responsibly, you're underwriting them conservatively, your capital investor is going to be happy, and it's going to be a very good and fruitful partnership for a long term. And you got to make sure you continue to do that. Any questions related to this topic, feel free to comment below. Happy to chat. Reach out to us at hardmoneymastermind.com. We've got a great community of about 3,000 other private lenders just like yourself.